Welcome back to Satoshi Finance viewers, to our exploration of economic indicators and their profound impact on our personal finances. In today's journey, we delve into the fascinating world of economics, where numbers tell compelling stories about the health and vitality of our economy. In the world of economics, indicators serve as vital signposts, guiding our understanding of the economy's health and trajectory. Essentially, economic indicators are statistics that provide insights into various aspects of economic activity, offering crucial clues about the overall performance of a nation's economy. These indicators range from broad measures like gross domestic product, GDP, to more specific metrics like unemployment rates and consumer price indices. By tracking these indicators, economists, policymakers, and individuals alike gain valuable insights into economic trends, helping them make informed decisions about investments, business strategies, and personal finances. Understanding economic indicators is paramount because they offer a window into the complex workings of an economy. Much like a doctor relies on vital signs to assess a patient's health, economists use indicators to diagnose the economy's condition and prescribe appropriate measures. For instance, a high GDP growth rate may signal a robust economy with ample opportunities for businesses and job seekers, while a rising unemployment rate could indicate underlying weaknesses or imbalances. By grasping the significance of these indicators, individuals can navigate economic landscapes more effectively, making prudent financial decisions and adapting to changing market conditions. In essence, economic indicators serve as indispensable tools for anyone seeking to comprehend the dynamics of the economy and its impact on personal finances. At the heart of understanding a nation's economic performance lies the concept of gross domestic product, or GDP. Essentially, GDP represents the total value of all goods and services produced within a country's borders over a specific period, typically a year or a quarter. It serves as a comprehensive measure of economic output, encompassing everything from the goods we buy to the services we consume. Broken down into four main components: consumption, investment, government spending, and net exports, GDP offers a holistic view of economic activity. Consumption represents the spending by households on goods and services, while investment accounts for expenditures on capital goods like machinery and infrastructure. Government spending includes all expenditures by the government on public services and projects, while net exports reflect the difference between exports and imports. But how does GDP impact our personal finances? Well, for starters, GDP serves as a barometer of overall economic health and growth. When GDP is on the rise, it typically signals a thriving economy with ample opportunities for businesses to expand and create jobs. This in turn can lead to increased employment opportunities and higher wages for workers. Conversely, a stagnant or declining GDP may indicate economic challenges ahead, potentially resulting in reduced job prospects and stagnant wage growth. Thus, understanding GDP and its implications is crucial for individuals navigating the ever-changing economic landscape, providing valuable insights into the broader trends shaping our personal financial well-being. The unemployment rate serves as a key barometer of labor market conditions within an economy, reflecting the percentage of the workforce that is actively seeking employment but unable to find it. It's a critical metric for policymakers, economists, and individuals alike, offering insights into the level of job opportunities available and the overall health of the labor market. Unemployment can be categorized into several types, including frictional, structural, and cyclical. Frictional unemployment refers to the temporary period individuals spend between jobs, while structural unemployment arises from a mismatch between the skills of workers and the requirements of available jobs. Cyclical unemployment, on the other hand, results from fluctuations in economic activity, such as during recessions or periods of low growth. The impact of the unemployment rate on personal finances is profound. In times of higher unemployment, individuals may face heightened job insecurity as layoffs and downsizing become more prevalent. This can lead to financial stress, uncertainty, and difficulty in meeting basic needs. Conversely, when the unemployment rate is low, it often signals a robust labor market with plentiful job opportunities. Lower unemployment rates can translate to better job prospects, higher wages, and increased stability for individuals and families. As such, understanding the fluctuations in the unemployment rate is crucial for individuals to anticipate changes in job market conditions and make informed decisions about their careers and finances. The Consumer Price Index, CPI, stands as a cornerstone in understanding the dynamics of inflation within an economy. Essentially, CPI measures the average change over time in the prices paid by urban consumers for a basket of goods and services, ranging from food and clothing to housing and transportation. It serves as a crucial gauge of price movements, offering insights into the rate at which the cost of living is increasing for the average consumer. Calculating CPI involves tracking the prices of a predetermined set of goods and services over time, and then comparing them to a base period. The significance of CPI lies in its role as a primary indicator of inflation. As prices rise across the board, the CPI reflects this upward trend, providing policymakers, businesses, and individuals with valuable information about changes in purchasing power and overall economic health. For individuals, a rising CPI often translates to a higher cost of living, as everyday expenses like groceries, rent, and utilities become more expensive. This erosion of purchasing power can have tangible effects on household budgets, leading to a decrease in savings and discretionary spending. Therefore, keeping a close eye on CPI trends is essential for individuals to adjust their financial plans and strategies accordingly in response to changing inflationary pressures. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. Interest rates play a pivotal role in shaping the economic landscape, influencing everything from borrowing costs to savings and investment decisions. Broadly speaking, interest rates represent the cost of borrowing money or the return on invested funds. There are two main types of interest rates, nominal and real. Nominal interest rates are the rates quoted by banks and financial institutions, while real interest rates take inflation into account, providing a more accurate picture of purchasing power. Central banks wield significant power in determining interest rates, often using monetary policy tools to achieve specific economic objectives. By adjusting key interest rates, such as the federal funds rate in the United States, central banks can influence borrowing and spending behavior, thus impacting economic activity and inflation levels. For example, during periods of economic expansion, central banks may raise interest rates to curb inflation and prevent the economy from overheating. Conversely, during economic downturns, central banks may lower interest rates to stimulate borrowing and investment, thereby spurring economic growth. The implications of interest rate fluctuations on personal finances are profound. Changes in interest rates can directly affect borrowing costs, influencing the affordability of mortgages, car loans, and credit card debt. When interest rates rise, borrowing becomes more expensive, potentially slowing down consumer spending and investment. Conversely, lower interest rates can stimulate borrowing and spending, providing individuals with cheaper access to credit. Furthermore, interest rates also impact savings and investment returns. Higher interest rates translate to higher yields on savings accounts, certificates of deposit, CDs, and bonds, making it more attractive to save. Conversely, lower interest rates may lead investors to seek higher returns in riskier assets, such as stocks or real estate. Thus, understanding the interplay between interest rates and personal finances is essential for individuals to make informed decisions about borrowing, saving, and investing in an ever-changing economic environment. Stock market indicators provide valuable insights into the performance and sentiment of financial markets, serving as essential tools for investors, analysts, and policymakers alike. Three key stock market indicators that are widely followed include the Dow Jones Industrial Average, DJIA, the S&P 500 Index, and the NASDAQ Composite Index. The DJIA tracks the stock prices of 30 large publicly traded companies in the United States, representing various sectors of the economy. The S&P 500, on the other hand, is a broader index comprising 500 of the largest publicly traded companies in the U.S., offering a more comprehensive snapshot of the stock market's performance. Lastly, the NASDAQ Composite Index focuses primarily on technology and growth-oriented companies listed on the NASDAQ Stock Exchange. These stock market indicators play a crucial role in gauging investor sentiment and providing insights into the overall economic outlook. Movements in these indices reflect the collective actions and expectations of investors regarding corporate earnings, economic growth prospects, and market sentiment. Rising stock market indices often signal optimism and confidence in the economy, while declining indices may indicate concerns about economic uncertainties or market downturns. As such, these indicators serve as barometers of market sentiment, helping investors and policymakers make informed decisions about asset allocation, investment strategies, and economic policies. The impact of stock market indicators on personal finances is substantial, particularly for individuals with investment portfolios. Fluctuations in stock market indices can directly affect the value of investment holdings, influencing portfolio returns and overall wealth accumulation. A rising stock market can lead to capital gains for investors, boosting their net worth and retirement savings. Conversely, a downturn in the stock market may erode portfolio values, potentially impacting long-term financial goals and retirement plans. Moreover, stock market indicators also provide insights into broader economic confidence and consumer sentiment. When stock market indices are performing well, individuals may feel more optimistic about the economy, leading to increased spending and investment activity. Conversely, declining stock market indices may prompt individuals to adopt a more cautious approach, potentially affecting consumer spending and economic growth. Therefore, staying informed about stock market indicators is essential for individuals to navigate financial markets effectively and make informed decisions about their personal finances. In conclusion, we've embarked on a comprehensive journey through some of the most essential economic indicators that shape our understanding of the financial world. From gross domestic product, GDP, to the unemployment rate, consumer price index, CPI, interest rates, and stock market indicators, we've explored how these metrics offer invaluable insights into the health and performance of the economy. By monitoring these indicators, individuals gain a deeper understanding of economic trends and their potential impact on personal finances. The significance of staying informed about economic indicators cannot be overstated. As we've discussed, these metrics provide crucial signals about changes in economic conditions, helping individuals make informed financial decisions. Whether it's adjusting investment strategies in response to shifts in interest rates, or preparing for potential job market fluctuations based on unemployment rates, staying abreast of economic indicators empowers individuals to navigate financial landscapes with confidence. As we wrap up, I encourage you, our viewers, to continue learning and staying informed about economic trends and indicators. By doing so, you'll be better equipped to make prudent financial choices, adapt to changing economic circumstances, and ultimately achieve your long-term financial goals. Remember, knowledge is power, and by staying informed, you take control of your financial future.